Hello, Lawrence from the editing studio here. Just before we get into today's episode, I hope you had a lovely Christmas. I just wanted to give a quick heads up that there are a couple of crackles in Megan's audio track at times. I've done what I can to mitigate those, reduce those. It shouldn't impact things too much. We still think you're going to get a lot out of this episode. That's all. Enjoy the episode. Hello and welcome to this week's episode of Companies and Markets Weekly. A couple of things just before we get started. We are recording this ahead of its release date, just so we can have a bit of a Christmas break. But what that does mean is that if we mention any statistics or any particular bits of data, obviously they were correct at the time of recording, which is about a week before it's meant to go out. Hopefully nothing changes too drastically between now and then. But just a little disclaimer that data was correct at the time of recording. May have changed a little bit since then. Other things, as with all of our episodes, we may mention individual stocks. Obviously, this is not financial advice. Stocks go down as well as up. We may hold some of the stocks that we talk about. If we do, we will disclose that certainly in the episode description. We'll try and mention it live as well. But yeah, now let's get into it. I'm joined this week by our head of content, Megan. Hello, Megan.
Hi, thanks for having me, and thanks for scheduling this recording. As you say, not quite in the main hubbub of Christmas, so that's good.
You're getting us before we've both eaten and drunk a lot over the Christmas period, so hopefully we may be slightly sharper.
Speak for yourself there, Lawrence.
Maybe slightly sharper and fresher than we might otherwise be. This week's episode, again, a little different from our standard fare. We're going to take a look back at the year that was 2024. And what a year it's been.
Yes, what a year it's been. I think a stat, Lawrence, that you you like because you've added it to the notes and you've also said it pre-recording. So I'll let you say it, but it's a good one.
It is a good one. I mean, obviously we'll dig into the markets and the companies in a bit, and that will obviously be the main focus of all of this. But it's been hard to sort of exist in 2024 without being aware of the global sort of geopolitical backdrop to all of this, which I think has had some influence on how the stock markets have played out over the year. We've had more than 60 elections across the world, one South Korean impeachment. I did look up whether we'd had any coups in Africa. We'd had 7 since 2020, but apparently we had none this year.
Well, things have been calm in Africa where they haven't been calm anywhere else. There you go.
Yeah.
I think, as you say, it's the companies that we really like to talk about at Stockopedia, but hard to get away from the fact that politics has had a fairly big role in how the markets have been behaving this year. Yeah,
absolutely. I was doing a little bit of reading ahead of this, and I found a really fascinating essay by the Pew Research Institute in Washington. And one bit of data that they shared stood out to me was that they polled a whole bunch of people across 34 different countries. And in each country, a median of 64% of people said they felt that the current economic situation in their country was bad. And more than half of them said they felt the way that democracy was working in their country, they were dissatisfied with it. So, I mean, my sense is that this year especially, people have come out and are very willing to talk about how broadly unhappy they are with the quote unquote the systems that are governing and sort of having a major influence on their lives. And obviously the markets are one of those. Obviously very recently in the States, we've had the murder of a healthcare insurance company CEO. And it's been really interesting to look at the response to that from people, which again is very much this bubbling sentiment of we're not happy with the way that things are going. How, like looking ahead, how insulated do you think markets and companies are from these effects of people just not being happy with the systems that are in place at the moment?
I actually don't think they're very insulated. I think the fact that we are kicking off this podcast and it's what we're talking about. I've read today an article which is going to be published by the time everyone listens to this, but it is not published at the time of recording. But it's been written by Mark, and he has started. 2024 has been a momentous year, and he's talked about the political situation. He's talked about the UK has had the first Labour government in 14 years. He said perhaps as much as a protest at the terrible job of the previous incumbents. The US has elected Donald Trump, despite him possessing character traits that would have disqualified him from any office, let alone the highest one. I think it is very, very hard to talk about markets, be involved in markets, invest anything without having some sort of awareness. So I don't think they're particularly insulated. I think because there is a lot of obviously sentiment, positive, negative sentiment, that drives how investors are what investors are doing. And I think more so than ever in my investing life have the behaviors and traits of the actual market had so much of an influence over what's doing well and what's doing badly. And I think it will be interesting when we talk a bit about some of the numbers, but looking at the stocks, individual stocks that have performed well, the individual sectors that have performed well, the markets that have performed well, it is very, very hard to make a fundamental investment case on those best performing stock sectors, markets. And I think that makes it incredibly difficult to find opportunities. It also means that there are opportunities which are not being priced in by the market at the moment, but it does make it very, very difficult to find and time them. And I think that is largely because we are currently in a period of pretty turbulent economic times.
Yeah, I was looking at not just the stocks and the markets that have gone up, but obviously reminding ourselves over the course of this year, gold has gone up about 28%. Bitcoin has more than doubled. It's now more than $100,000 per Bitcoin. Not that we're going to talk about Bitcoin primarily. Coffee is also up 74% year to date, which obviously makes it incredibly difficult for millennials to afford houses. So looking at the years, lots of things have gone up.
Yeah, absolutely. I think, the price of gold is, as a lot of investors know, that it's an asset that investors flock to when they're looking for a safe haven. It's a so-called safe haven asset. It's funny that Bitcoin is enjoying a similar surge. Potentially, we are seeing new entrants to the market this year. We're seeing more and more investors of a younger demographic. I think the continued evolution of platforms, brokers, digital or fintech, which is allowing more and more entrants to the market, which is allowing more and more people to access assets like Bitcoin in an easy way. I think that's an interesting factor at play. I mean, Bitcoin, I don't understand it. I don't touch it because I don't understand how it keeps driving to these new heights. Gold, I understand a bit more. I get that there is a strong market for gold when people don't really know what's going on. How long that will last in 2025, I'm not sure. The soaring price of coffee is to do with farming conditions, and we've seen that in a few of the agricultural commodities. A weak season makes the price go up, and that has happened for coffee beans. And as I referred to in my week ahead last week, if you want to understand that more, I highly suggest watching Trading Places over Christmas, because that is a fantastic film for understanding the price of commodities.
I've not seen it.
Have you not seen Trading Places?
No.
Oh, you are in for a treat.
I will have to watch it. When you said it was your favorite investing film, I was like, what was mine? I do like The Big Short.
Yeah. There was a comment on that article which said, you're wrong, it's The Big Short.
In terms of individual companies that have done well, badly this year, it's hard to look past the US tech sector as a starting point for that.
Yeah, it is. And I think, when you're looking at markets as a whole and the performance this year, it is very, very hard to look past the US tech sector. Obviously, people talk about the performance of the US in 2024 and they talk about how wonderful it's been. It has. The S&P 500 is up 28% this year. But drilling down into why it's performed so well, I think is very interesting. And I think it actually presents a bit more of a negative story. So S&P 500 up 28%, S&P 500 Tech Index up 44%, Magnificent Seven, so that's the 7 biggest stocks in the US, includes Apple, Amazon, Google, Alphabet, and crucially Nvidia. So Magnificent Seven as a whole up 71%, Nvidia up 171% in the last year. So US tech, specifically artificial intelligence, has been a major driver of the strength in the S&P 500 in the US tech space. The fact that the US markets are driven higher and higher by passive fund inflows. The Magnificent Seven currently account for about 40% of the S&P 500, which is it's a market cap weighted index. So it feeds a virtuous circle of demand and growth. So more investment, more passive fund inflows, the bigger these biggest stocks get. And that's great if you're holding the S&P 500. So I track the S&P 500, and it's far and away my best investment this year. Which I'm pleased with, because yes, some of my individual holdings have not done so well. But it is interesting that has largely come from a handful of stocks. It is not the S&P 500 as a whole, which is interesting, which is potentially a little bit worrying. And it's something that I wrote about quite a while ago. It was just before the pandemic, that obviously this trend can reverse. We can, if passive fund outflows start to happen, then the biggest stocks within those passive funds will be the worst hit. Money will come out and the bubble might, maybe not burst, maybe that's a little bit too drastic, but certainly deflate. And I think that is something to be wary of. The reason I am not currently wary of it is because I don't think the AI market has got anywhere near the point of maximum, the point of no more growth. We saw Broadcom at the start of December release its financial results for 2024. Broadcom is a semiconductor company. It isn't actually a direct competitor to Nvidia. It operates in the AI market as well, but it operates more in the software space. Nvidia is more in the hardware space. But Broadcom said that their current addressable market is worth about $20 billion. And they're expecting that by 2027, it's going to be between $60 and $90 billion. So that's within 3 years. And it's already a market that's worth a huge amount more than it was at the start of this year. So I do think it's hardly surprising that the US tech sector, the tech sector, the AI sector in general has been driving markets to new highs. And I think it's likely to continue.
And I think we only have to look at some of the valuations in the US to I think possibly see how full the keg has been stuffed.
Yeah.
So the current average price to earnings ratio for stocks on the S&P is 23. The Nasdaq apparently has averaged a PE of 25 since 2006. That was from a PensionCraft video I watched. The Magnificent Seven, I think you've done some numbers on that, and they're at 53 average. Mm-hmm. Tesla's forward PE is currently, according to our stock reports, 135.
Yep.
CrowdStrike, which is not even Tesla and CrowdStrike are not even in the Magnificent Seven.
Tesla is.
Oh, Tesla is it? My bad.
Tesla is. Yeah.
Okay. CrowdStrike, people may remember from earlier this year, deciding to take every single Microsoft device offline for a period of time. They've recovered from that mishap. They're now trading on a forward PE of 81 again. these are ludicrous numbers, aren't they?
Yeah, they are, and I think this is my current problem with investing in the US. It's so difficult to make a rational fundamental investment case. I think Tesla is an interesting one. Tesla, very much a company which benefits from the voice, the celebrity of its chief executive, of the fact that it's a car company, but it's not being pitched as one. It's not being valued as one. The markets don't see it as a car company. It's worth, I can't remember what the exact stat is, but it's something like it's worth more than 4 times the value of the next biggest 10 car companies in the world put together. Not a car company, really. But I think the general point about big US tech valuations is there's just no point in even looking at them. I made a sell case for Apple probably about 3 years ago when it crossed the $1 trillion barrier. I just said there were a few little things. It was when it was going through a bit of a legal problem with the company that makes the Fortnite gaming world, and I thought like any little slip up like that, any little legal wrangling would knock it off its perch, make people really question the PE ratio. But it's now worth 3 times that. And we see it the same with Alphabet. Alphabet has had a very high profile legal case this year, which concluded you need to split out Chrome. Its share price is up in the year. Like, that's just extraordinary that it can be going through such a really high profile risk to its ongoing operations, and people are still wanting to buy. It's interesting. I also found it very, very interesting that when we spoke to our subscribers, we said we asked them what kind of analysis they'd be most interested in. We gave them a list, and they put under the radar US stocks ahead of high profile US stocks. And I think that's really interesting. I think there is so much coverage of high profile US stocks, and I think there is enough fundamental value in the US, in the companies in the US, although it's very hard to make an investment case as a private investor on those stocks. That means that they are going to keep driving higher. I think with Donald Trump now as the president, with his very much US big business focus, the regulation that is required to stop these companies completely dominating the world isn't going to happen. And until that happens, until someone really changes the regulation and says, no, Alphabet, you can't own Google Chrome and the search engine that is that is on everyone's devices, and you need to spin it out right now, I can't see how these companies will be stopped from getting bigger and bigger.
I also can't necessarily see a situation in which, even if Alphabet were told that they would, I can't see a situation in which anyone would be able to force them to comply with that, because they are so big.
Yeah. So I think it's an interesting time to be an investor. And I think it's different. People have often made comparisons with the .com bubble, but a lot of the stocks that were trading on ridiculous valuations there were just complete speculations. These big stocks are not speculations. These are dominant forces in everyone's lives, and we can't avoid using them anymore. Like, I've had an argument with someone recently because they were refusing to use Amazon for their Christmas presents, and I was a little bit frustrated because this person also admitted that they were among the top 10%, I think it was, of spenders on Amazon because they use Kindle, they use Audible, because it's very practical to use Kindle and Audible.
Yeah.
They also can't avoid using Amazon Web servers. Like, we use it at work. Those are the servers that we use. So all you're doing by shirking Amazon at Christmas is annoying yourself and people who then have to listen to you moan about the fact that you've got to trudge into London to go and do your shopping, or delivery times are rubbish, because you're using Amazon. You're using Amazon every day, even if even if you don't want to be.
I'm sure Jeff Bezos is really annoyed in his spaceship. Shall we move on to the UK?
Yes.
Which is, safe to say, not had such a good year. Certainly not relative to the US.
No, definitely not. So FTSE all share up 6%. I mean, at least it's up. AIM down by the same amount. It's been a very bad year to be an AIM investor. So it's not just that it's down 6%. It's actually down 11% from its highs. So it hit highs in May, and since then it's been a rough second half of the year for AIM investors. But having drilled into this a little bit more, I feel like there are reasons for optimism, because there are lots of sectors that have performed very well within the FTSE this year. Aerospace and defence, I mean, driven by Rolls-Royce, BAE. The tech index, I mean, nowhere near as strong, obviously, as the US. Even the retail index, done better, outperformed the FTSE all share. So I think there are reasons to be cautiously optimistic about being an investor in the UK, because there are opportunities, and I think it's particularly good for stock pickers because there are opportunities for good companies, and the market is still rewarding good companies which perform well, which beat expectations again and again. So yeah, I think while it hasn't been a particularly happy year to be, or a particularly easy year to be a UK focused investor, and there is a lot of rubbish in the UK, I also think there's a lot of good, and hopefully some opportunities.
Yeah, obviously, I think a lot of AIM stocks took a real battering in the lead up to the budget this year, because they were expecting a big shift in inheritance tax and business rates relief. Do we expect that to continue, sort of the consequences of that to continue unwinding in the first few months of 2025?
Probably not in the first few months, because the changes to business rate relief don't come into play until the next tax year. So not the one that starts in April 25, it's the one that starts in April 26. So AIM has still got another whole tax year of the 100% relief from inheritance tax. I think that AIM as a whole does need some looking at. I think there's so much junk on the market, and it's shrinking quite drastically, and we're seeing, because the quality is diminishing, fewer and fewer companies are looking to list on the UK. I was annoyed a few weeks ago when we were all talking about Shein or whatever it's called, the Chinese fashion company. And oh yes, finally a company wants to list in the UK. We don't want that listing in the UK. Like, it's rubbish. It's a horrible company. There are so many brilliant companies in the UK. There is so much innovation coming out of our universities. Let's look at finding some appetite for that sort of company to list here, rather than a questionable retailer from China.
Yes, I agree. I went and looked back at a couple of articles that our CEO Ed wrote over the last month or so about the top trending stocks over the last year. He was looking at stocks that have really been on the move. And I thought it was interesting because he rounded each of those articles off. I will link them in the episode description with some of the themes that he pulled out, because he analysed the sectors that were behind those stocks. For the UK small caps, he said the big build is coming. So he's talking about house builders and he said, in a gold rush, sell picks and shovels. Gold is back, and this effect was also seen in UK mid caps. There were lots of gold miners rallying around defense spending, and particularly cybersecurity as well. You mentioned tech earlier. In the mid cap space, there was more construction and infrastructure, but then also, I think looping back to what we said near the start about Bitcoin and new investors coming into the market, there was apparently a big rise in certain trading and investment platform stocks, so CMC Markets, plus 500. Interesting stuff.
Yeah, so companies like that benefit when markets are volatile because there's more trading that happens. CMC Markets, IG, plus 500, they all make most of their money, from volatility, from investors coming in and out of the market. IG in particular makes a lot of money on investors buying and selling on leverage. Volatile markets tend to support outperformance in those kind of companies. We've seen St James's Place has recently gone back into the FTSE 100 as well. It's I don't love St James's Place, but it is the kind of company that benefits when people are worried about their financial situation. More people seeking advice, more people wanting to do more with their money. So companies like that tend to do quite well. And on the point about the momentum, I think the best performing stock in the FTSE 100 this year is Rolls-Royce, which has very much been a momentum play in 2024. It has benefited from people being wary about defence and the increase in defence spending, but it's also just going up and up and up because people are worried about missing out. For the last few months, there hasn't really been a value argument to be made at all about Rolls-Royce. This is a big lumbering, it's a massive company. And it's not a fast mover at all. But its share price just continues to rise, up 98% this year. And that is a real testament to the fact that winning stocks keep winning. And I think that, for me, is one of my biggest takeaways from 2024. I've never really fully understood the momentum factor. It is one of the three factors that we use in our stock ranks, in our QVM method. And I've always struggled to get my head around momentum, but 2024, it's been a real case study in the power of that factor. Even in markets that aren't doing particularly well, like the FTSE 100 hasn't been a spectacular market, but the individual companies with the wind in their sails have just continued to rise, even when earnings maybe haven't kept pace with the pace of growth of the shares.
One of our colleagues, Dan, has also been doing some analysis and bringing up some insights from our platform and from our users on the platform. Megan, do you want to speak to some of those?
Yeah, I found these really, really interesting. So, there's more detail about this in the article that I published last week. But some of the key highlights, some of the things that we were really looking at here is where our users have been searching for stocks. I went to Dan because I was interested. I thought, with all the strength in the US this year, have our users been searching for US stocks more than they had done in the past? We tend to see UK stocks among our most viewed almost every single day. Occasionally, Nvidia shows up. But as expected, the UK stocks continue to be the most searched for. But there are some sectors, the US in particular, where our users have looked to the US, for most of their searching. So software and IT services in particular, semiconductors. That is where, so 20% of people who were looking for stocks in the US were looking for semiconductors or software and IT companies. Surprisingly, just under 10% of people who were searching the UK markets on Stockopedia were also searching for software and semiconductor companies. Obviously, a lot lower than the number of people searching in the US. But I thought that was really interesting. The other thing I thought was quite interesting about this was the comparison of the most searched for stocks within those sectors, which I think this is a slightly less positive thing for the UK. So in the UK, the top 3 searched for stocks in the software sector were Interseed, Cohort, which I would argue is a defense company, and Beeks Financial Cloud. In the US, it was Alphabet, Microsoft, and Meta platforms. They're just not really comparable as companies, and I feel like we could be doing better in the UK. But then there are also sectors where I think there are some brilliant companies which are being well searched for among our users, and I think one of these is the biotech and medical research sector. Again, US more popular than in the UK, but the 3 most searched for stocks were hVivo, Bioventix, and Genus, which are all really brilliant stocks, and it compares to Moderna, which was known for its COVID vaccine, but hasn't done an awful lot of good since then, and 2 others, Vertex Pharmaceuticals and MedPace Holdings, which again, not particularly magnificent companies. So I think there is some pride to be taken in the fact that we've got some great small companies in a very innovative, very exciting area of the market.
I guess the question is, at what point do people sit up and finally take notice of them? We've also had some other colleagues doing some research this year, haven't we? They've got some interesting insights.
Yeah, we've done a lot of research into various different topics, which I encourage anyone who hasn't read some of the topics to check them out. Alex has looked into all sorts of things, but most recently he's looked into the difference in individual value ratios and how they can hint at potential outperformance for companies. And the companies which tend to do the best, the value plays which tend to do the best, score highly on multiple value ratios. So we've spent a fair amount of time today talking about the PE ratio, but actually, if you're looking for value investments, looking beyond the PE ratio at the stocks which score well on 3 or more value ratios can be a good way of identifying winners. And it's some research that we're going to continue into the new year. We'll look at it for quality and momentum as well. Ed has started looking at it with momentum, and he's found a similar sort of insight. So that's a bit of a breaking news, a headline for you, because that's not research that we've published yet. But he has found a similar thing. So companies that are doing well, their momentum score, or their share price momentum is high across both 50-day and 200-day moving averages, are more likely to continue to outperform than those that only are scoring highly on one of those. So yeah, lots of interesting insights. Interesting to the extent that we've decided to split out our blogs. So any users will have seen a new blog structure. Last month, in November, we changed up our blog structure, which will allow us hopefully to keep providing these data insights, because I think they're really interesting, and it's certainly making me think more about buy investing and how to use maybe more. Maybe what I have previously considered as quite unusual investment techniques, are really momentum driven, like some elements of value in there, some deep value. I think I've never really looked at deep value before, but I think there are certainly some deep value opportunities in the UK at the moment, and money to be made on a short term basis. And hopefully some of these data insights will help more of our users benefit from the kind of knowledge that we have within Stockopedia.
What's been your favourite bit of content on the site this year?
I have to say that today I read a bit of a spoof article that Mark wrote about translating the market lingo, and it honestly made me laugh out loud, which is potentially a bit of a nerdy thing to admit. I was thinking about showing. I was thinking about showing my sister, being like, "This is a really funny article," and then I was like, "Actually, she's not going to care." But yeah, it really made me laugh. And I think the other thing about it is it's very true. I hate companies which use ridiculous jargon and lingo to pretend that they're not doing as badly as they are. And Mark's written it all out in slightly cynical, but amusing. An amusing way. So I recommend that. I feel like that is doing a slight disservice to some of the research that both Mark and Alex in particular have done this year, because there has been some really, really interesting research. Another article that I found really, really interesting and opened my eyes a lot, as I say, to momentum, is an article that Roland wrote about the impact that momentum has had in his investing. He runs our SIF folio, and that has he said that he's been really surprised at the impact that the momentum factor has had in that portfolio, and I think that's a really useful insight, especially in a year like the year we've had.
Nice. My favourite one, I think, was a webinar that you and Ed did recently on when to sell. I thought that was really eye-opening. We had some really good feedback on that one as well. It was a hotly requested topic from people who've attended our webinars. We asked people what they wanted to see, and that came through loud and clear as people wanted to understand when to sell.
I think that what was really interesting about that is that we've always said it's a really hard question to answer. There's no right answer, and it's true, there isn't. But I was actually surprised at how clear an answer we could provide to that question, because it's not about, there is no one rule, but there are rules, and there are very clear rules that can be followed with when to sell. And I think a lot of it comes down to the kind of investor that you are. I tell myself that I'm a buy and hold forever investor, which means I never have to address that question, but it's partly a bit of an excuse so I can be a little bit lazy. But I do think that, depending on the type of investor you are and your holding periods, what you want the money for, what you are investing for, I think there are answers to that when to sell question, and a lot of data, a lot of research that backs it up. So I found that very interesting.
I agree. I will use this to shamelessly plug the fact that we have a calendar of events planned for the beginning of 2025. We do. I will provide a link in the description of this episode where you can go and check those out and sign up for them if you would like to come along. My other favourite development of this year was the fact that we started this.
Yes, finally, a good development, and looking forward to doing more of them in the new year.
Absolutely. And on that note, I think we're going to wrap it up there. Thank you very much, Megan.
Thank you.
And thank you very much for listening. If you haven't done so already, we would really, really appreciate you rating us on whichever platform you're listening on. I think all of them offer some ability to give a star rating. You can leave comments, you can leave reviews. I go and read all of them because I want to make sure that this is as good as possible. And if you know of anyone who you think would benefit from hearing about our podcast and listening to it, please do share. We would love you to spread the word. Thank you very much for listening. I hope you've had a wonderful 2024 and all the best for 2025.